Property Investing Insights, your authority on all things property investing, finance and wealth creation with Right Property Group.
Hello everyone, and welcome to Property Investing Insights. This is the one without Phil, so we get the meatier stuff here where I talk about client stories. And today's guest, he's got a license to chill. He's a chill guy, and I can attest personally to his expertise in his industry. But I've jagged him and bagged him to come into our podcast to share his story because he's got a good story to share, a journey of over a decade with property investing, starting with one property and having now multiple dozen plus properties. And the journey, of course, has never been smooth, but it has been predictable. So welcome, Mitchell Burge.
Thank you for having me. It's nice to be here with you again.
Yeah, you're not a stranger to RPG,
No,
so you've been around.
You've been looking after me for a long time.
Yes, yes. And the reason why I wanted you here, Mitch, was that you're going on a hunting trip, and we were talking on the phone,
Yep.
and you said that, look, hey, investing has allowed me to do so many things, and it's life changing. And
Yep.
it dropped a penny to me to say, hey, I need to share this with my other clients and people that are looking to invest and starting to invest, along with taking away all the clutter of information that we've got, right? And you've been on the soapbox before in terms of these new age information coming through the media articles and so forth. And let's start with what do you do to begin with?
I run an air conditioning business. Have down now for about 17 years with my business partner Alex. I love it.
Yep.
I've been doing it a long time. But the property is what's given us stability. Business is one thing, but running property alongside it has truly been what's given the stability.
Yeah, yeah.
It really has. You taught me that many years ago. So did Alex Whitlock. But moving forward now, the properties are now outperforming business.
Yeah, which is a really good position to be in, right? But in the initial stages, of course, you needed the stability of the business to help with the instability of starting the portfolio.
Yeah.
And now it's changed totally 360 in the sense that
we planned this many years ago. And it's one thing to plan it, but then when it actually happens and it's real, it still doesn't feel real.
Yes, yeah,
yeah,
it does. And so I'm going to go backwards first, right?
Yep.
When you see articles today of own multiple properties or replace your income or buy in this area, what does it trigger in you?
Anger, because this done incorrectly could destroy a life.
Yeah.
That's somebody's hopes and dreams, their future. The biggest investment they'll probably ever make is their property. I've been lucky enough to have people like you and Phil and Alex and Steve, the late Steve, to sort of mentor me.
Yep.
Where we did the right decisions, and it's been well over a decade now, and there's not a bad one there. They've worked. And I'm seeing some of these new articles come out, and when I saw some bloke the other day on Facebook feed saying he's got 79 properties. I'm looking at his age and I'm thinking you couldn't have been doing it for more than 9 years. And that it's making a passive income. Not possible.
Yeah.
I've got the figures down to the cent. You've seen the way we balance. It's not possible. If you've got 79 properties and you've done it in 9 years, I would love to see his books. The LVR would be through the roof and it'd be running on a knife's edge. Can be done, but it's definitely not passive. And if you're running an LVR as high as what I'd suspect, the holding costs would be through the roof. And you'd have to be jumping from loan to loan to loan and selling one all the time to then fund the next one. It can be done, but on an edge, which is not what we were about.
Yeah.
So I don't buy into the short-term hype or trends or take more of the stable long-term approach. And the reality is, even though my LVR is 50, it still costs me a little bit.
Yeah.
And I'm okay with that.
Yeah. So the target was more in our journey when it started, target was more getting growth rather than cash flow. And the cash flow will come, right? And there are many things we can do within the portfolio right now, such as building granny flats, or we've got a couple of development sites tucked away.
Yeah.
We pull the trigger on those. It will actually make the portfolio quite positive.
But we're not after that.
Yeah, we're not after that, right? It's a choice that's perhaps the end game. or the alternative is to let it run its own course and pay itself out.
Probably run its course on this, but you and I talk about that a lot.
Yeah.
But that's why in the beginning, you bought me house, which was usually negative cash flow, but long-term positive gain. And then would sit down and have a chat, and then you'd go, maybe we need to look at a unit. Units typically don't have the long-term gain, but the yield's a little higher.
Yep.
So that's why we went house, unit, because we could sort of, when I didn't have the raw cash back then and the business was smaller, it was a way of still building the portfolio and balancing it out. But now we're past that. I don't want any more units.
Yeah, that's right. Yeah, so that was the ultimate pigeon pairing, where you've got a high growth property and you're underpinning it with a good cash flow property.
Yes.
To dampen the negative cash flow, so that it then increases your borrowing capacity or stabilizes your borrowing capacity.
Correct.
And we are then able to go again. So what got you the investment bug? How did we get started?
Did a podcast with Alex ages ago on this.
So Alex, for the listeners, he's the other half of Smart Property Investment, Momentum Media, and a good friend and an avid fisherman as you are.
Yeah, that's our good mates for a very long time now. No, we actually went fishing, and we knew each other for a long time, but we just fish and we're friends, and we never really talked about much. And about work stuff. And I said, I was thinking about buying a new boat or investing. And then we got talking, and that's when he introduced me to you and Steve. And 2 weeks later, I was settling on a place at Minto.
Yep.
It happened very quick, and then we just went back to back to back. And I'm glad that was a very good fishing trip, that one.
Yeah, of course. And now you start from just getting fish, you started fishing properties as well, right?
Well, it's just as fun. It's a hunt.
Yeah, it is a hunt. And you're right on that, right? Because you do get that sense of achievement, and the thrill of the hunt, and which is also a double-edged sword, right? Because it can be too addictive in the sense that you then get lost in the transaction of it rather than the outcome of it.
True, but that's where I've been lucky enough to have people like yourself around, because I am that way where I go too hard, too fast, and you pulled me in a couple of times and gone, well, maybe we take a breath. You'd think because obviously you're getting an agent's fee, but no, you've been the one that's actually slowed me down. And but that's you need that. You need good people around you to sort of tell you, and with their experience looking at the outside. And sometimes harder when you're in the middle of it to focus on it.
Yeah. So when you're in a journey, obviously there is always some aha moments and some moments of doubt.
Yep.
What's one aha moment that you had in the journey so far?
Probably 2014, you bought me a place in Minto, just under 1,000 squares. You've got some in the same street.
Yep.
For 260,000, I think, which is worth 930 or 940 now. So it's been a really good property. Thank you again. But I wasn't sure at that time, and nobody knew. Nobody has a crystal ball. Then I didn't have the equity back then to keep buying there, so we had to go to Queensland.
Yes.
And you picked Queensland perfectly, but you picked it very soon, and there was a long time. I then went and bought 9 up there, and then
with virtually no growth.
With no growth, and I remember, because I was still new to it then, and then I watched Sydney keep going, and I remember you and Steve having a chat to me saying, well, you couldn't afford to keep going in that market in Sydney because the yield was terrible. You couldn't have held, so you bought a lot in Brisbane. Wait, and as the years went by and it did nothing, you and Steve kept a calm head, but it was hard for me at that time because I was watching Sydney go and Brisbane do nothing.
Yep.
Well, yeah, it went. And so the trick is, if you've got good property and good people around you and they predict it, is time and hold and patience. So I saw even some of the most avid investors I know, like Alex Willock, he let go of Brisbane.
Yes.
He got out of there, and we were chatting about it the other day, and he goes, maybe I shouldn't have done that.
Yeah.
But he had another journey and another plan he wanted to deploy that money into. Well, I held, and it's paid off very well, probably more so than if I held in Sydney at that time, because that market went through the roof.
Well, it would have reduced the number of properties and therefore the diversification of your portfolio and diversification of the risk if we had totally been Sydney centric. And equally importantly, we couldn't be totally Brisbane centric either. It needed to be balanced in terms of and understanding the cycles in each state, which was it's hard, even though the data was there, it's hard to portray that with someone that's just started.
Yeah.
Especially when you've got all of this other data saying that, if I had bought in Sydney, it would have gone faster.
Yeah.
Right? But the journey ultimately remains the same in terms of the growth that you have. And we balanced that out with some really good cash flow properties. They were not brand new properties.
No, by no means. But with the resources I had to burn at the time, I had a partner, I had a mortgage, I had a small growing business at the time, which is much larger now. So I didn't have the cash to burn on it. And I could have only maybe supported 1 or 2 more properties in Sydney. Once Minto went up that far, the yields were terrible.
Yep.
The holding cost would have, I couldn't have gone that far. By going and getting 9 in Brisbane, they were nearly neutral at the time when you put me up there. So it allowed me to probably accrue 3 times more property than I could have if I stayed in Sydney. So hindsight, I wouldn't have changed it. It was perfect.
Yep. So where are we sitting in terms of numbers of properties?
We're sitting on about 17, 18 now.
Okay. Yeah.
Probably we've sold 2 in the last year and a half. They'd kind of done their cycle in that they needed a lot of maintenance. They were in an area where they were cash flow positive. I don't need that so much now, and I wanted that liquidity to use elsewhere.
Yeah.
And I'm currently just building on an investment at the moment where we bought land, and I'm kind of changing a little bit.
Yep.
In what I'm looking at, because it's more mature now. I'm not chasing the cash flow as much now. I'm chasing better property and less headaches.
Yes, of course. And this is one of the things that I find very common with the investors that have gone through at least a decade of the journey, is that in the initial stages we do have to then buy what we can in not having the lifestyle cramping that investing in the wrong properties gets you. And then you find that there's a change in appetite in terms of, okay, I don't want these hands-on properties as much. I would prefer to be still hands-on, but perhaps I need to have a better outcome in the end in terms of maintenance, in terms of looking after the properties, and hence the change in terms of you from the stories you've told me that you jagged onto that land, and now you're going on to build on that, and it'll have good depreciation, it'll have good end result in terms of equity. But just as importantly, as we're talking off camera, you could be a developer and not make as much equity as opposed to getting established properties and just sitting it out.
Well, I'd never buy a block and split it. That's not my thing. I'm not an expert in that. Don't want to be. I like what we're doing, but I don't mind. I'm just experimenting, buying a block of land, putting a cheap project home on it, and seeing how that goes. Because it's easy. I can still concentrate on my business. You can put a deposit down 5 years earlier. You get 5 years of growth. I put the deposit on this one down in 2019. So I got all this growth. And all I did was put down a $50,000, $60,000 deposit. And now I'm building on it. And I'm just seeing where it goes. But again, I can experiment now. Years ago, I had to do that journey to get to this point where
you couldn't afford to lose.
Oh God, no. No, but now I can.
Now you know, even if it goes pear-shaped, you've got a very soft landing because you're sitting at 50% loan to value ratio.
The worst case that happens is it breaks even or goes slightly down, and then I do nothing. Time will fix it anyway.
Because it's in the right area, right?
It's in the right area.
You haven't compromised on that fundamental. When you own that many properties, obviously there are some hairy moments from a tenancy point of view. Are there any anecdotes that you can share?
Good with the bad. There's going to be bad moments. We had a major incident last year with a tenant, which was even the police were involved. They were on the phone to us as a landlord. It was a terrible scenario, but you've got to start somewhere. And that particular place was in an area that's a bit rough, but I couldn't have got that yield and that gain if I didn't hold that. And the places are insured. The worst they can do is damage it. It's happened. And I use, what's the insurance company you put me on to?
EBM.
EBM, sorry. They've been brilliant. We haven't had to make too many claims, but I found when I've had to, they're there. They know what it's about. They've really looked after us. So I'm not even that threatened. The worst that happens is I damage a property, I have an incident. It's just, to me, part of the normal business. I didn't buy in those areas not understanding what they were, and I got the gain and I got the yield out of them. And in time, those areas are actually getting really nice. People think of Minto still and go, oh, yuck. When was the last time you drove through there?
Well, when we bought Minto, it was called Minnow, because it had a very strong housing commission element in there. But the trend had already started to sell down the housing commission to owner occupiers, which was what led us there. And that's not data led, that's ground knowledge led in those areas, right? So the adherence these days to data and the diversification or digression away from on the ground knowledge has got a lot to answer in terms of people buying in the wrong areas or buying the wrong type of property at their stage of the journey, right? So and we've been discussing this for quite a while in terms of this shift towards data needs to be taken with a grain of salt. You can't just rely on data.
Well, I think it was Steve that told me a very long time ago, the worst investors are lawyers and accountants because they overanalyze to the point they get paralyzed, they make no decision. And if I listened to everybody that said you can't do this or gave me all the reasons why it shouldn't be done, I would have been paralyzed and never made a decision.
Yeah.
And it's obviously paid off.
Yeah.
I've got the freedom now to the financial stress in my life is gone. And again, we were talking earlier, sorry, when we're off the camera, the main thing about this is now, without you can work and get an income, and many people work and get an income. But if you're relying on that income, you're never going to do well.
Yeah,
you're never going to be wealthy. You've got to be able to deploy a percentage of that income into an investment, and it's got to be a passive investment. So it means that every time you wake up, you're making money. And the ultimate dream is if that passive income can eventually overtake your normal income. And that's where I deem it successful. And not many people do that, but it's totally achievable. Like I'm a tradie.
Yep.
And through the people I've met through you and Steve, so many people I've seen do that. And on my side now, my passive, not that I'm drawing it, it's an equity. To me, it's just all on paper. I don't see it. But that equity far makes more than I do in business now. But the freedom of what that gives me now is, even throughout COVID and inflation and bad government and a failing economy, it would take an awful lot to collapse me now.
Yeah.
Because
you've got a solid foundation now.
The foundation's there, and that lets you sleep at night. And also, you got to think the country is not in good stead. If you look at our debt, it's going over $1 trillion. If you look at the handouts, we're now spending more than we're taking in. These are all bad trajectories. And a country, when it keeps going that trajectory, eventually can't keep funding the way it is. So hospital services, things eventually our credit record, if nothing changes, will go. Eventually we're facing a big financial crisis if we don't get spending underway. And that means you're going to have to look after yourself.
Yep.
And I look at my kids and I think you're not born into the opportunities I was. So I think I'm the first generation born into less opportunity than the one before me. My kids are born into less than me. So to me, this is more intergenerational wealth. Not a handout. I just want them to be stable. And it's covering the next generation. Because I think there was a very long time of stability, which is somewhat disappearing now. And you got to take some accountability and start planning for your future.
I agree. You know, we're getting into an aging population, right? So and there isn't enough younger workforce coming in to support the older population. So if you look at it from that viewpoint, there won't be enough money in the system, if I can use that word, to support the retiring population. So we need to obviously focus on being self-funded in terms of retiring, without taking unnecessary risk and without compromising lifestyle, right? Because throughout this journey, yes, there were a few moments where the cash flow became a little bit of an issue. But it was never to the point where you're down to 2-minute noodles or that. There's more mental than anything else.
More mental, because it is daunting when you're used to dealing with smaller figures and all of a sudden you're looking at how much you owe the bank and things like that. But over the years, it's a growth stage. It's like going through from primary school to high school. It becomes normal operation. If you run proper figures, you're used to seeing the P&L spreadsheet on it. You go, well, it balances, or it's negative this a month, and there's a hot water system. Okay, I've got a budget for that. But you just don't push yourself too fast. Obviously, I chose to go hard. I think we did 9 purchases in a year and a half at one point. It was a year and a half. That was calculated. That was aggressive. Probably wouldn't do that again. But it was the right time in the market to do that.
It was, because the prices were lower at the time in terms of entry point. But now the same properties, you're probably paying 3 times more.
You couldn't do that now. No, it was the right time. It was a calculated risk. And at that time, I also had no kids. Business is growing, so it was calculated, and it's obviously paid off. But the trick is time. If you buy a place and sit on it for enough years, it's going to go up. Even if you're paying interest only, it's going to go up. And eventually the rent will go up.
Yes.
Your holding costs will probably hold as the rent goes up. So everybody's got a different story and it is a different process. If you just do one and say you're 30 years old and you retire at say 70 in these days, you've had 40 years of growth.
Yep.
If that does 4 cycles, that's 4 times, and you bought it for $500,000, there's 2.5 million. You're sitting on $2 million equity there. You can retire off that.
Of course.
If you just do one. But if you just did that and got 6 years of that cycle and then leveraged off that again and only took 10% of it out to do it again, your holding cost of that first one would have gone down to a point that you're not even that far out of pocket. You're fine.
Yeah.
Even if your passive income hasn't changed. But one of the things that I wanted to chat to you about was people putting themselves under, just through trained habits, under stress that's not needed. I, in the initial part, paid principal and interest, P&I, because that's what you're told to do, pay down your debt. I went back, my mum's a single mum, and I remember when I was a kid, she bought a house in Mount Coller for $83,000. She sold it in 2016, I think it was, for 1.27.
Yep.
Now, I remember how much we went without when I was a kid, having a single mum, because she wanted to pay the debt down. Yes, when she sold it, she paid all the debt down. She had no mortgage. But the difference in the payments between P&I and interest only for all those years and the quality of our life, and that was obviously a principal primary residence, was not worth it. If I look at if she just paid interest only, if she was allowed to at that point, the payments would have been a lot less. That would have been quality of life, more weekends away. Don't be afraid for the first 5 years of an investment paying interest only. If you've got, is my thing, if you're a long-term investor and you're in there for 20, 30 years, interest only is not a problem. Because if you're after the capital growth, paying an extra $100 out of your pocket a week, $5,000 a year, is nothing in the big scheme of things when you're talking about 500 or 100,000 or $1 million property going up 10% a year or 8% a year. That I wish you'd told me about it. I wish I learned that earlier, because I think I put myself under a bit more pressure than I needed to.
Initially, you did principal and interest, isn't it?
On everything.
Yeah.
And and everybody told me otherwise, but it was just how you're trained to think, and it makes sense. But I look at what came out of my pocket and the sacrifice on lifestyle, which was not necessary. When I look at how big it is now, that was nothing.
It was.
It was a drop in the ocean.
And I'm so glad you brought that up, right? Because one of the things I continually say to people is that lifestyle in the forefront, investing in the background.
Yes.
Yeah. That doesn't mean that you just, blow your money away. You're quarantining some of your cash flow towards investment.
Yes.
And you're not letting it be life consuming, right? Even though with your scenario, you went fairly aggressively, we did correct it so that it was more lifestyle balanced than anything else, right? And off the back of the portfolio, you bought and built your home.
Yep.
And you're giving anecdotes of how the portfolio has enabled you to help your mum in terms of her property. And this is all, you can't really see that when you start the journey, because the journey is all about, okay, I've bought a property and I've got my first repair bill, right? And that's always hard, right? And it's not the same picture I have in my mind in terms of what a property should be. Yeah. So it's a big paradigm shift.
It's got to be, if you're going to do it, it's a 10-year cycle minimum. I've seen a lot of people jump in, interest rates go up, they panic, they get out. If you get out under a year and a half or under a year, you're probably going to lose money. By the time you pay your taxes on the way in, taxes on the way out, you can actually go backwards. We capitalize off most of the properties you've got me is from somebody that's done that.
That's right.
You're getting a suppressed sale. But it's a 10-year cycle on patience, and there's going to be ups, there's going to be downs, there's going to be a bad tenant. But nothing in this world's easy, and without dealing with that, you don't get the gain. But at the moment, currently, if I'm on average doing about 24, 25 grand a week in equity. I don't see it, it's on paper. I don't live the lifestyle. I'm a tradie.
So no Ferraris?
No Ferraris. I wouldn't know how to live that life. I think it's a really healthy way to be, because it's easy for me to go back to the bank, sell a property or redraw and live that life. So I can do that now. but that's just not how we're wired. And to me, it's on paper. We still live to a very tight budget. You've seen our place.
Yes.
I still haven't even fixed the pool yet. We live a normal life.
Yeah.
But every week, the portfolio goes up a huge amount. And it's, if you put it into a compounding calculator, at 50% LVR, we're just, the portfolio has just gone over 15 mil. If nothing is done for 10 years, that'll go to 30 mil.
Yep.
The LVR will go probably, I'm still paying P&I on a couple of things I shouldn't. We'll probably go down to 25%. There's nothing more to do now. Anything from here forth is because it's fun.
Yeah, that's true. And you call me often and say, oh, should I sell this and we can deploy the money elsewhere and buy more? And I always ask the same question, right? Why?
Why?
We are poking the bear unnecessarily.
Yeah.
There are times where it does make sense to deploy the money elsewhere if it's gone through its cycle and that, but now you don't need to.
No.
You're doing it because you want to.
Yeah.
Yeah.
My threshold's 50% LVR. The banks have a clause called the all money clause.
Yes.
Meaning for no reason whatsoever, they can wake up tomorrow and call your loan in. The great thing about Australia is, as much as people beat the banks, I think we have the best banks in the world.
Good.
I love the banking system. The bank gave me my first house loan for $500,000 when I was like 18 and a half. I love the banks. Even when I've had a bad experience with them, they always come to the party, and our banking system's fair. I've only ever met one person that they've called that clause in on, and that was my uncle in 1987, I think it was.
Which was the downtime of property.
Westpac nearly went under.
Yes.
Those days are gone. They've got tools now where they work with people. They're not going to do it. They're not in that game, and you've seen the profits they're making, and good on them.
Yep.
I'm for the banks. I've made money off the banks. You need a strong banking system. I want to leverage as much. I need them strong so I can leverage and do as well as possible off the banks.
Yes, that's the bank calling, by the way.
Is that the bank?
Yeah.
Probably after, I know how many mortgages you've got.
Yeah.
No, it's been particularly interesting journey with the banks. In the early days when my LVR was very high, I think at one point I was doing business with 9 different banks.
Yep.
Because I felt that I had to have security.
Yes.
If one called in, but now I'm now zeroing it down to the big 4.
Which is a journey, right? So it is a finance journey. So initially you want to be really mitigating all your risks and being able to leverage off a good valuation of one bank and going to another lender, and also because of the buffer rates. If you've got all the lending with the one bank, obviously they'll lend you less.
Yes.
But as you've built your portfolio and you become equity rich, it makes sense to then simplify the lending.
Yeah.
Certainly, that's one of mine and Reshmi's bugbear is keeping track of where the loans are sitting, which lenders got what. It is hard, yeah.
It is hard, but the 50% LVR is my threshold.
Yeah.
If you're at 50% LVR, you're safe. And that's anything, once something goes below 50, that's where I feel that you can take a bit of a punt.
Yep.
And that's when you said that people get to a certain point where they start experimenting outside of this business model.
Yep.
But if you're a standard tradie like I was, running a small business back in the day, and you got to get started, that's the only way I can see to get started. But what's been a really interesting journey is, which I spoke to you about previously, and we did a chat with Alex on it, was my niece. She's a nurse. I hear so many people now telling me, I can't do this.
Yeah.
This is too difficult. So
and she's a good story.
Oh, she's great. She's a nurse.
Yeah.
She worked at IGA from 14. She worked the night shifts, which was double pay. She worked after school. She worked weekends. And she said to me a long time ago, Mitch, when I get to a deposit, can I come and speak to you so we can deploy this? And I went, your family, of course. I'd do this for anybody. Anybody that wants a hand, I'm open book. She came to me with 246,000.
Yeah.
And you put her in a place in Melbourne last November.
Yes.
Very well placed. 900 squares, I think, or 950 squares, 3 villas on it, all Torrance title. She's settled into that. She's coming to you in the next couple of months to go again, it looks like. It's barely costing her to hold.
Yeah.
And again, if that's all she does at 24,
that's it.
She's good.
Yeah.
But she'll be going again soon. And now one of the lovely ladies I work with, Amy, you're just finding a place for her. And the reality is, Amy, even though she's on a good income, she's my maintenance manager. She doesn't have she can't buy in Sydney. And instead of crying like a lot of people, oh, it's too hard and this is really difficult, she's looking outside the box.
Yeah.
And she's that purchase will be in Melbourne, and she's got approval, and you're in the market looking for her now. But if she can get 4 or 5 of those properties under her belt, then she can offload those at a later date and double back to Sydney. It's really if you're starting from a base and you're under sort of $250,000 a year, which is most people, which is what you need. If you're a couple living, you need at least $250,000 to buy $1 million property now. So it's a way of deploying resource into cheap housing to build that wealth elsewhere to double back into Sydney. Instead of just lying down and saying it's too difficult.
True. It's a stepping stone, right? And the important bit is that every property that we buy as an investment portfolio, we need to take the approach that that's the only property we'll ever be able to buy, because life may happen, or lending may change, or it takes you another 5 years to build up the next deposit, or the courage to go again. Because not everyone's journey is like yours, right? Where you set a target and you went for it. So it's really important to understand that when you're starting to invest, you really need to focus on that one property that we take the approach to say things will go wrong in the first 18 months. So what's my exit out of this property? And this may be the only property I may be able to buy. So will this be life-changing for the negative, or will it be life-changing for the positive, in the sense I could then leverage off this at some point in time after it goes through a cycle, and show something for my work and for my decision making, as opposed to just getting into the vogue area that's been purported on Facebook and TikTok, or getting into an area where the parents say that it's a good place to buy, right? And that's one of the biggest hurdles I find, is that when you've got family members advising you, usually they're advising people through either fear or through their journey, right? In your case, you're guiding your family and friends through your journey, because you've gone through that. You know what works and what doesn't work, and you've gone also through that mental growth in terms of the paradigm shift, in terms of recognizing that not everything should be principal and interest.
No,
it could be utilized for lifestyle expenses. It could be utilized to hold another property, or it could be just comfort in life.
Well, I'll listen to anybody for advice, but then I'll filter it and I'll think about it over a few days and think. And in property, what I found is everybody's an expert. But then I usually ask, so what have you invested in? And that's when you usually get that blank look.
Yes.
So everybody's an expert and then I usually find out, well, they haven't. So I try to lean on the people that have and that have been successful, and just ask basic questions. And that's where I've been lucky to have such a great circle, where I've had you, the late Steve, I've had Ross, I've had Alex, I've had Phil, all successful investors. I know how big your portfolio is. I know when you started, and like me, you came from nothing and you built it from the ground up with your lovely wife. And you're very humble, and I'm in trader uniform, and you'd never show it, but I know how big your portfolio is, and it's impressive. Taking advice off people, it's usually out of love. They're worried about you. They tell you not to do something. It's because it's scary. I remember one of my best friends, when you found me the first place in Minto that we talked about earlier, said, "You're mad." Now, that was the first investment, but my first house was in Mount Colah. I paid in 2007 $500,000, I think it was. That place is now worth 1.8 or something. If you look at the percentage growth of Minto, it's outperformed it tenfold. If you look at the percentage in Brisbane, outperformed it.
It's not a place you would live in.
No.
Right? So it's not in your circle of friends. It's not in your lifestyle sphere.
It's an investment.
It's an investment.
It's an investment. But it's even Amy that I talked about. She's had a few people tapping in, going, "Oh, maybe this is scary," and I've talked to her about it. And I said, yeah, it is scary. It's huge. But you got to trust the process, and you got to take a risk. But you've surrounded yourself with a really good agency and people that do this themselves, and it's experience. Because I bought my first place. It's 20 years ago now. Probably a bit longer, actually. Like, we're older now.
Yes.
You got the experience to make a calculated decision now, and it becomes easier.
Yeah, but it does become easier, but it also becomes a lot harder in terms of, okay, is this the right one? Is this the right next one? Am I doing the right thing? Because as you grow your portfolio, you also get that innate fear that, okay, I don't want to, with the next edition, I don't want to undo all of the hard work I've done, right? So as the portfolio progresses, it becomes harder and harder to slot in the right property into that mix. In the initial stages, it's fairly easy, right? The first 2 years, 3 years is very easy because you're still laying the foundation.
Yep.
Right. If I can use the house analogy, so you're laying down the slab, and now when you get into year 10, as an example, now you're doing the finishing touches, right? So it then becomes a lot more meticulous, and if it goes wrong, it shows very, very quickly.
Yeah. But can we touch base on Melbourne at the moment?
Absolutely.
It's we talked about it a couple of months ago. Everything we discussed is happening. It's just a perfect combination. You gave me some data. I looked into it. You're 100% right. I think it's 42% of their revenue is coming from property revenue taxes, transactions. It's been 2 Labor governments in a row, which, forget politics, but it's something you can bank on. They've spent more than they're bringing in. They've had to cancel the Olympics. So financially, it's a basket case. And we've watched every other state around it just go through the roof over the last 5-6 years, but they've continually underperformed.
Yep.
And it's just because it's been an unattractive place, and it still is. They've got taxes that other states don't have, but it's almost like a trickling effect. The others have gone up so far, and even though it's a basket case, it is still the second biggest economy in the country. It still has the second biggest migration flow. It's performing, but it's not because it's doing well. It's performing because everywhere else has done so much better.
That's right.
The investment's flowing into there. So we're in the market looking at that now, and I'm just calculating what we're going to do there.
Yep.
The opportunity there, but we talked about it even 5-6 months ago, but it seems that it's now people are onto it.
It's turning, and that's because it is by far, from a capital point of view, the cheapest place to buy.
Yep.
Not necessarily from a cash flow point of view, right? Because traditionally Victorian rents are lower in comparison to dollar for dollar in another state. But that's the beauty of it, right? So understanding the metrics, understanding the cycle, and being ahead of the curve in terms of when the general populace starts bouncing on that, it may be time to actually sit back and watch how it unfolds, as opposed to getting there really early in the piece. Yes, there is a little bit of thought process in terms of getting social proof in terms of growth. But having a good portfolio behind you, you can afford to get into a market much earlier.
Yeah.
And really pick the gems out of the market, as opposed to getting into competition stage, which slowly Melbourne is starting to get into that stage where, if you look at where Perth was, where Brisbane was, where
it's got the same feeling.
It's got the same feeling, right? And it's only a matter of time. But just like any other state, people will get burnt, because particularly in Victoria, because of the tenancy laws and the various intricacies of how properties work there.
Yeah.
If they choose the wrong type of property in the wrong area, it's going to do more damage than good.
I just can't understand how, after I've got a place in Perth that I bought in 2019 or 20, and it's not even a nice place. And it was just a one-off sale. I didn't even think too much about it. And I paid $380, which is now worth like $660.
Yep.
And I'm looking at the suburb and I'm looking at the place, but then I'm looking at nice suburbs around Melbourne, which are now undervalued compared to what I've got in Perth. And I look at the two areas and I'm like, the Melbourne one, there's got to be a correction. And I'm talking like 20-30%. Because the equal parity, say you look at the same, and you taught me this, but I checked it and you're 100% on. If you look at a suburb in Melbourne, same suburb in Sydney, it should be 72% the value. And it's not. It's down to 50 now, roughly.
Yep.
So just a correction's already 22%, 20% roughly.
Yeah. So if you're bought in the right area, you're sort of guaranteeing yourself that 22-23% correction
before you get a run.
Yeah, before you get a run, right? So the trick is being able to hold on for that long when that correction happens. Because like you said, right, my crystal ball's the same as yours. I bought it from Kmart. It gives you the same prediction. It's just that I look at it more often, so I can say, okay, it's probably going to have a run within the next, say, 18 months to 3 years. But you need to be able to hold on to that to be able to materialize that growth and therefore get that equity behind it.
This goes back to what we said earlier. If you're not in it for a 10-year cycle, don't do it.
Don't do it. Yeah.
I don't really care if it's a 5-year or a 2-year from now. I know it's going to run.
Yes.
So I don't care.
Patience is the game.
If it runs in the next year and a half, great. but it's all a paper gain for me. But I know it's going to happen.
Yeah.
So to me, I'm not fast. I'm long term. If you're in short term gain, you probably shouldn't be doing this, because you won't have the patience or the stamina when things get tough.
Yep.
You got to just have the long game in mind. It's a minimum 10 years, I feel, minimum 10-year cycle, and hold on, and it won't always be easy, and be patient.
Yeah, which is one of the concepts we teach, which is design your decade, right? Because it is a 10-year journey. That way, your thought process matures, your lending matures, the property itself goes through its growth phase and starts to mature, and you are then able to get the very strong foundation to then say, okay, we'll leave it alone.
Yep.
Or we're going to launch from here into bigger and better things, or we'll repeat the same, right? So for each person, the journey is different because the goals are different.
Yeah.
Now, it'll be remiss of me not to ask what your retirement plans are for this portfolio. What is the thought process there?
That's the problem. I've sat down with you and Steve, and originally was drawing up these plans, but I've stopped.
Yep.
Because it kept surpassing. And I
All
kept changing. We killed the expectations so far that the 5-year plans are being hit in a year and a half, and it's now more fluid. And I don't need a retirement plan, because it's
it's going to be there.
Well, if nothing changes and it doubles in 10 years, there's 30 million. And that's without income normally. That's just it. That's itself.
Yeah.
Without any income being put into it. So
I just want to circle back to that, the 30 million, right? And just put it in perspective. Most people if they're not investing and they're relying on superannuation, at best they'll have 2, maybe 3 million super fund to play with, right? Whereas you could liquidate your portfolio and have 30 million to play with.
Yeah.
And the reality of it is that with the advance in science, advance in medicine, we are living longer.
You're going to need that.
Yeah, you're going to.
3 million doesn't go as far as you think it does.
Yeah.
And I know what my kids cost in schooling. So it gives options. So I think about it a lot, but the answer is I don't know, because right now I love my job. I love the people that I work with. I love what I do. I've got a good income. I don't need that. So it's just something that's accruing wealth by the day, by the minute. And it's actually fun. It's like a chess game.
Yeah.
And all it needs is patience, persistence, and time. And it just seems to be accruing wealth.
Yeah.
I think the end game will be when I've had enough of everything, but I don't think that'll ever happen.
Yeah.
And I will probably sell down X amount to buy another place on the water and relax, and probably sell down one every so often. But the thing is, you don't pay your real taxes, and it's not real till you go to sell it. And I kind of don't want to, because if you've got, you can't borrow money from the bank and leverage if you don't have an income.
Yes.
So to have an income and have property gives you options, because then you can always leverage off your property, and there's no other way you can get tax-free money.
I agree.
You can go to the bank tomorrow. Say you've got 15 mil worth of property and it goes up 10%, you do 1.5 million in a year, and you need to do a renovation worth 300,000 to one of those properties, and you take out 400 and put 100 in your pocket. You've still got to that's a loan. You don't pay tax on a loan.
Yep.
That's tax-free money. You're still paying it. You got to pay the payments on it. But if you've done 1.5 million in that year in equity, and you're taking out 400, you're still 1.1 in front.
Yep.
It's a no-brainer. You find me another way you can do that.
Yeah.
You just can't.
Look, this is a concept where people get it the wrong way around, right? So they try and do this right in the beginning of the portfolio, where they're trying to leverage and live off the equity.
No,
this is really in the tail end of it, where you can actually, in a safe, predictable manner, use some of it and draw down the equity via loans.
Yeah.
To live off it, right? But you've got to be very careful that you don't outlive your ability to make the repayments and to draw down the equity. So there needs to be a blended approach of, again, there's some properties that are paid off. There's some properties that you're going to sell. And there's some properties that you leverage off and then leave it as a headache for the next generation, right? Because they'll thank you for it, because these properties will go up substantially in value, and you're handing them a asset that's continually growing in value. Yeah. So if you met Mitch of 15 years ago, what would you tell him?
Do exactly what was done. It's been an awesome journey.
Yeah.
I've lived it through you. You've made me wealthy. You've covered probably the next 3 generations of Burges between you and Steve and Alex and Phil and all your advice. And it's totally achievable. And that's why the only thing you guys have asked from me is to pass it on. So that's what I try to do, pass it on.
Yeah, and you do that well.
Yeah, I try to, because it's changed my life. It's probably changed the next 3 generations, and it's been fun. It's been a journey. And the biggest pressures most people have in their life are financial. They're gone.
Yep.
They're gone. And it makes life a lot more enjoyable. And it was a bit of pressure in the early days, but you can take in the pressure now. You don't have to take the pressure later, and do it in your 20s if you can.
Yeah.
Because you're never going to be hungrier, have more energy. And I can tell you, once you're in your 30s and you probably have kids,
life changes.
And your expenses go up. And the bank looks at you and they go, if you're 20 and you borrow a loan and you're going to retire here, you got that much time to pay it. If you take a loan in 40, you're going to have to pay back payments a lot higher because you've got this much borrowing capacity. So a lot of people I find when I meet them and just chatting conversation, they go, I'll wait till I'm ready, till I'm more mature. Bank doesn't see it that way.
Yeah.
The bank wants you young.
If you wait till you're ready, what you're really waiting to do is to pay more, right?
Yeah.
That's the reality of it.
And usually when business, when your life expenses have increased, there's often a kid, you could have a dependent, and that's when they won't lend to you.
Yep.
So you've got to get in there young. You've got to get in there, and there's always a million reasons you can't, but if anybody can. If you're a labourer on a construction site now, you're on 45 an hour, you can do it. A labourer on a construction site, that's before you're even a skilled worker. Yep. So it's absolutely doable. So anybody that says they can't, they're not investing.
You just need to make up your mind to get started. That's what it is. And the rest will fall into place.
It sorts itself out. And you'd be amazed if you tell somebody, and I know from experience, go and save money and put it in the bank.
Yep.
Very hard. Take out a loan though. On property, good debt. There's a difference between good and bad debt. You go and take out a loan and have to make those payments, you figure it out.
It's forced saving, isn't it?
It's forced saving.
Yeah.
I know myself when I was younger, I couldn't save. I tried. I did save actually quite a bit, but it was struggling. And I used to look at it in the account and go, ooh. And I remember when I was 18, friends wanted to go overseas, and I didn't. But it was hard. But when I had to make a loan payment, it's forced.
Yeah.
You have to. And if you're built with the right grit, you don't miss it.
You don't miss
it. Make it work.
Yeah, absolutely. And once you've got an expense that's regular in your financials, it then becomes, you don't actually miss that money, right? You adjust. Yeah. So that's where, when you're starting out, you do need to stretch a bit.
Yeah.
And often that's what I tell people that are just starting up, is that it's not going to be, this sudden amazing result.
No.
You have to work for it.
It's very slow. But sorry, to probably answer a bit differently with what I probably would have gone harder.
Yeah. Most investors say that.
Yeah, I probably would have gone harder.
Yeah.
Because I did go very hard, but now I look at it and go, that was fun.
Could have stretched a bit.
I could have stretched. Now I know what I know. I could have, and that would have been it. The properties wouldn't have changed where you purchase them. The plan we had was perfect. I just probably would have gone a little bit harder. But I wouldn't recommend that to anybody.
No. And things do change, right? When we started, the pricing was easier. The yields were slightly better at the time. Yeah, rates were lower. And now the prices are much higher. The rates are, I'd say, medium at this stage, right? And it's harder to get those loans. So there's a slippage rate between the money coming in and money going out. So we need to be cognizant of that. And life's become more expensive.
It has.
So inflation's gone up.
But can I mention the weekend's election? Because that's going to be an interesting one. I don't care what persuasion somebody is. Bad for the country if you're in business or trading or work on construction with the unions. It's a death blow.
Yep.
But for investing, brilliant.
It's brilliant, yes.
It's brilliant. If you're a young person trying to get into a home, probably really bad. But right now, that's opening up huge investment opportunity. I know from personal experience, working under this government is very hard. Their taxation they put on us, all the red tape. So nobody builds under this government. It's too hard. It's not hard to see if you look at the statistics on building in houses.
Then we're already in a deficit.
And we're already in a deficit because it's just too hard to build under Labor.
Yeah.
But what that means is, I can promise you supply and demand. The building is not going to happen. They've bring in record migration when they've been buying boats, and they've had record migration coming in. Hence, you can see the election results. But those people need to be housed.
Yeah.
So probably not good long term for our kids or the country, but
good time to invest.
Good time to invest. Supply, demand, migration. You put them together, you're going to have a run on them. I believe you put those three together right now, you're going to have a very big run on the cheap housing market. Sort of the $500 to $1 million market houses is going to run. So we're possibly, not possibly, we're jumping back in at the moment. We're just doing the homework on where that's going to be.
Yep, no, absolutely. So we could continue talking,
Yep.
because both you and I are very passionate about property. But what's one word of advice that you would give to the listener?
Patience, and don't believe everything that you read about passive incomes and things like this. If it sounds too good to be true, it is too good to be true. I'm still negative cash flow at 50% LVR, and I don't draw an income off it.
Yep.
You just need to be patient, 10-year cycle, and don't sell out.
Yeah.
So if, like you said, on the Brisbane properties, we went 4.5 years with literally no growth, which I couldn't understand. Now it more than recovers. Just be patient. It's if a suburb sits there too long, it will catch up, and it usually does it very quickly. Just patience, persistence, and don't look for a golden cure. A lot of these people I'm seeing on Facebook at the moment are selling dreams that aren't true. Like the NDIS get a $2,500 net income away. That's ridiculous.
It has to be set up the right way to be able to do that, right? And
yeah.
Talking about the portfolio itself, and you mentioned that it won't be positive cash flow. In yours, you could make it positive.
I could.
Choice, right? It's a choice, right? So and that's really important that each person's got their own journey. Look, fantastic to have spoken with you. For those that are listening, if you're in Sydney, License to Chill. I've personally used his services, so really good in terms of solutions for air conditioning. And you're mentioning that you're looking for apprentices, so if you want a leg up into the industry, contact us. We'll put you in touch with Mitch. Thank you, Mitch.
Thank you.
Thanks, mate. Cheers, mate.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.